Evening, everyone in India. Sorry to rush the earlier panel, but it's my teaching day and I have a finite constraint on when I need to get to the classroom. So sorry about that. I thought I'll talk a little bit about something I'm trying to learn myself that's underway in India and that I found fascinating. But given that I'm still learning, interpret whatever I say with, the right levels of caution, in the sense that it's possibly an exciting development, but it's worth considering. So I wanted to talk about loan service providers, which is being proposed as a new paradigm for credit to micro, small, and medium-sized enterprises in India. Notably by iSpirit, which is developing some of the public digital infrastructure for having open credit enablement network for lending to MSMEs. Mr. Nandan Nilekani, Sharad Sharma, who have headed this digital think tank, have already spoken about this in end of July, but I've been interested all through my research, and especially when I was at the RBI, in how to sachetize credit in India and make it of the right size and of the right tailored to have the right properties for MSMEs. And what they are doing seems to be an interesting development. And so I thought I'll talk a little bit about why it could be a way forward for sachetizing credit and making it more sensitive to the cash flow patterns of the MSMEs. Now, just by way of background, our formal financial system in India continues to fail most of India's businesses in a number sense. MSMEs have historically faced a massive credit shortage in India. Just to take some numbers, there are, by some accounts, 65 million MSMEs in India. They employ about 110 million people. They contribute to 40% of exports, 45% of manufacturing output, and about 30% of India's GDP. And yet, the sector has been estimated by the RBI's MSME expert committee report that was chaired by Mr. UK Sinha last year. Their estimate was that this sector has unmet credit demand of about rupees 20 to 25 trillion. That's a fairly non-trivial credit shortfall. And in fact, as per a recent IFC report late last year, so about 12 months back, 10 months back, only about 16% of the MSME debt demand is from the formal sources. Now, this is overall a paradox as far as credit outcomes in India is concerned. Dr. Rajan and I recently wrote a report on reforming India's banks. And we start out by presenting a number of such paradoxes, which is that, we've had 40 to 50 years of nationalized banking, and yet our aggregate credit ratio to GDP is only 56%. On the one hand, we have such a low credit to GDP ratio, even such a low ratio for lending to MSMEs. And I just got a report today from CIBIL, etc., that the MSME loan portfolio of public sector banks has NPAs of close to 20%. Now, when you are underserving a sector, you would think that you are probably lending to the highest quality firms, and you are not able to actually lend well down the curve. But it seems there must be a failure in the credit technology itself. Because how can you be under-providing credit to a sector and yet have non-performing assets which are so phenomenally high? The numbers are approaching close to 20%, and they are ramping up very quickly during the COVID phase because of cash flow problems. And in particular, the COVID has also increased the demand for working capital credit at these firms because many small businesses are facing falling revenues and delayed payments from buyers because a lot of discretionary expenditures have been on hold for some time. They may pick up soon, but my experience sitting here in New York is that even when the curve subsides, it takes a while before full economic activity comes back because it has to be somewhat of a gradual reopening of the economy. Now, what are the outcomes of all this? The outcomes are that the MSME demand has to then be met, unfortunately, uh, by the equivalent of loan sharks and so on, who very often charge usurious interest rates. Now, some of the larger MSMEs may be fortunate to work with microfinance institutes or NBFCs who have much lower default rates and higher recovery rates than the banking sector does. Private banks also seem to be dealing better in their portfolios with default rates on MSMEs, though their lending is not as large to the MSMEs in the first place. Nevertheless, it seems even the microfinance institutes and NBFCs, they do charge fairly high interest rates to make up for high processing and capital costs. So the situation for MSME credit in India, as far as banking is concerned, is therefore that banks, through deposit insurance, etc., have the lowest cost of capital, but they don't safely disburse credit to MSMEs at scale. And I stress the word safely. They don't seem to be getting it right because the NPAs are very, very high. Now, as far as the technology of lending to MSME is concerned, and this is where I think there must be a problem because you can't be lending very little to a sector and yet have high NPAs, is that the processes are paper-based and highly manual. That results in a very high unit processing cost per transaction. The small ticket size that is associated then with most MSME lending doesn't justify the bank to acquire new customers, process the loans, and repayments. All of these require costs when you are lending at the last mile. So most banks can comfortably be profitable by serving higher income customers or larger businesses, or at least in a relative sense, even if they are making losses as a whole, in a relative sense, the costs are much higher for lending to the last mile. And there are some 30 odd types of loan products, I'm told, that are provided in this segment to the MSMEs. Now, most of these products, and this is crucial, they maintain physical collateral requirements. In fact, if you talk to India's banks, they often say, we don't do cash flow based lending, we do asset based lending. That's the term that they use a lot. Now, a lot of MSMEs don't have pledgeable collateral. They do have cash flows, but often the cash flows may be not captured in terms of their patterns by the information that's gathered by banks, because maybe they don't actually, they are not involved in the MSME payment and business cycle in any way. Banks are not embedded in the MSME ecosystem. And then banks have no incentives to innovate further on product types because they actually are not part of that ecosystem and don't understand what exactly is the type of cash flow structure and needs of the MSMEs. So in order to get a more symbiotic and optimal credit system, ideally one wants the lowest cost of capital, which is with banks, to reach some of these credit-worthy borrowers in this segment so that their demand for credit is met and the products are tailored to the nature of the payment cycles that they have. Banks can provide a valuable liquidity function for these borrowers, but it seems that right now the technology doesn't seem right. whatever they are doing in limited capacity is leading to fairly risky lending. And I should add here that some of it may just be because it is underwritten by a government credit enhancement agency, so that the incentives to monitor, etc., are much weaker on banks. They may simply be trying to meet some quotas or mission targets that are set for them, especially with the public sector banks. So a solution that's being proposed by iSpert, and as I said, it was already sort of discussed in end of July by Mr. Nilekani in some interviews, and then it has been blogged about by some of the new fintech players on the internet. I'm just still learning about this. But what they are proposing is that perhaps India needs new players to increase the reach of the low cost of bank capital to creditworthy MSMEs. And these players are being called as the loan service providers, or LSPs, in order to help banks through the LSPs get embedded into the MSME ecosystem. So this is what the structure would look like. The lenders would not be directly interfacing with the MSMEs, but they would be going via intermediate agents called LSPs, loan service providers, who are MSME facing, and they are already engaged in some other form of business with the MSMEs. They are part of the business ecosystem with the MSMEs. Now, in which way is this connection to the last mile MSME different from the historical arrangements? Historically, banks have relied on what are called as DSAs, the direct selling agents, and these are agents of the lenders. They are both sourcing agents, so they try to help banks acquire new MSME borrowers, and they're also collection agents. They help collect timely repayments. Now, as I told you, that historical model has led to low credit penetration and fairly risky loans. So clearly the DSA model has perhaps not served its objective to the extent that one had hoped. Now, the loan service providers approach is a similar idea, but it has one important departure, which is that the direct selling agents, the DSAs, are not involved with the MSMEs in their businesses. The whole idea of a loan service provider is that today the Indian ecosystem has thousands of service providers who face MSMEs. And these service providers can now provide both the borrower sourcing, and through the fact that they are involved in payments with the MSMEs, that payment connection can also serve as a valuable repayment function for the lenders once we connect them. And I'll try to explain what is being proposed here. The key point is that unlike the direct selling agents, which is the current bank model, the LSPs have an existing relationship with the MSMEs before any banking relationship is developed. They are part of the business ecosystem. So let me just make this concrete with some examples. Say Tele or Khata Book provide accounting software to MSMEs. Swiggy and Flipkart aggregate restaurants and small businesses to provide digital sales. Pine Labs or Razorpay offer payment gateways for MSMEs. All these companies have data to predict an upcoming need for credit. They know the transaction and cash flow structure of their clients. And using this data, they can possibly predict future demand of business in these firms and their possible capacity to meet repayments. Now, the loan service provider, in principle, therefore, has information to identify, suggest creditworthy MSMEs to lenders. But even if they don't perform this function themselves, the fact that there may be records of transactions with the LSPs can serve, quote unquote, as a valuable information collateral. And then banks can possibly design the sizes of the loans, the maturity of the loans, the repayment structure, how much liquidity insurance they want to provide, etc. They can design these product contours based on this additional information that they have. On the borrower side, the LSPs can be the channel through which digital loans can be provided as banks' lending products to the end customers, the MSMEs. And whenever a payment is made to the LSPs as a part of the business payment of the MSMEs, that repayment can get a haircut as a part of the payment that needs to be made to the loan. So there can be an automatic repayment to the banks based on a repayment that's being made to the LSPs. In fact, I think this may be the most interesting model where payment gateways act as loan service providers, and they simply earmark an upcoming cash flow to go directly towards a loan repayment. So you don't need per se a collection mechanism as long as an underlying business cash flow is actually getting processed through the ecosystem. Of course, there are other LSPs. This could include e-commerce apps, Kirana tech, agri-tech, legal or tax filing apps, gig economy apps, neobanks, payment gateways, supply chain financiers, loan selection apps, social media apps, and very interestingly, government offices with data on MSMEs such as GSTN or GEM, the Government Electronic Marketplace. Now, the other important point is that unlike the direct selling agents, the loan service providers will be agents on behalf of the MSMEs. In a way, bank did not start the relationship with Swiggy in order to reach an MSME. The MSME and Swiggy had forged a relationship themselves before the bank or the financier even enters the picture. So this way, the LSPs would have a huge interest in maintaining the sanctity of their relationship. So while many conflicts of interest can potentially arise in introducing a third party in a credit transaction, here the loan service provider, which is acting as a third party, not in the contract, they are just acting as a third party in making the loan application visible to the MSME from the bank and facilitating information exchange from the MSME to the bank in order to help customize the right kind of product. The loan service provider would have a lot of skin in the game because they value the end customer relationship, and that's why it's useful to embed finance into the ecosystem rather than thrusting completely new direct selling agents into this framework. So just for sake of argument, imagine if GSTN, the Goods and Services Tax Network, was to become a loan service provider. GSTN has information on invoices that MSMEs have, the larger MSMEs, which will be repaid in the future. So if GSTN becomes a loan service provider, the MSME could digitally and securely share these invoices with lenders through the electronic consent framework, which is in place as part of the existing Indian apps. They can obtain real-time loan offers from multiple lenders on the basis of this information collateral, the invoices. They can select a loan and have it be disbursed straight into their bank account because GSTN already has this collection. And this would be far superior workflow to the current bill discounting products, such as the TRADES database, TRADES system, for example, which requires the buyer to confirm the invoice for security through a fairly lengthy process prior to sanctioning of the loan. So you can create a true seller financing product and make it more seamless by putting it on the same network where the payments are actually taking place. So visually, what's being anticipated is that currently the MSME system looks like this. It's fairly complicated. You don't know who's connected to whom. And so it's not a very organized way of going from point A to point B as far as financial transactions are concerned. What iSpirit is visualizing is that the new credit ecosystem for Bharat could look like this, essentially, where you organize it into a set of end MSMEs, a set of end lowest cost lenders, which are the banks, and a series of intermediate loan service providers who are already connected to MSMEs and become the vehicles through which credit information is exchanged and credit and repayments disbursed and collected. So essentially, you have lenders here sitting at the center, the MSMEs on the outer ring, and the LSPs who are already connected to the MSMEs would now help organize the information and financial flows back and forth. Essentially, what does this require? This requires that banks begin to work seamlessly with many partner loan service providers. And the idea is that it should result in lower customer acquisition cost, lower underwriting cost, and lower repayment costs. Only if one can ensure a reduction in the costs relative to the current system with direct selling agents will this be a win-win. I think loans can be small, loans can be short maturity. In fact, they very often are. When MSMEs start out borrowing in the first place, they build credit histories and then they are able to get better loans. But the key seems to be to reduce the administrative costs as well as the financial costs of connecting banks to the MSMEs. Now, before I lay out some of the challenges and how they will be tackled, let's be clear that some things LSPs do not do. They are not lenders themselves, so they are not going to be providing financing directly. They may, but that is not the current visualization of the loan service providers model. They are just like an MSME facing app, if you want, in the modern economy. So Google Pay is a consumer-facing app for a bank-to-bank payment. It's not actually making any financial payments itself. And crucially, the loan service provider is not a third party to the loan contract. Okay, the contract will remain between the MSME borrower and the lender. Now, with that clarification, what are the two key challenges? The two key challenges that have to be tackled are the following. One is that loan service providers have been trying in the past to partner with banks and other NBFCs. However, because the bank or the NBFC process has been very cumbersome, especially in terms of requiring papers and collateral, physical collateral or asset-based lending, etc. So these manual and physical processes have to be bypassed, at least wherever possible. And second challenge is that you want the system to be very open, because once the MSME gets logged in to just a specific loan service provider, the loan service provider can possibly start charging hefty margins. Of course, the loan service providers may charge a fee to the MSME for being able to provide all these credit products and others through their apps. But once they are logged in and others can't actually get onto the LSP network, let's call it that, then the gains from lower costs may get eroded with the monopoly rents that the LSP may try to extract from the MSME. So in an ideal situation, LSPs should be on a network where new LSPs can enter very quickly, and therefore LSPs should ideally not have a big monopoly power, at least not within the set of LSPs that are facing a given MSME. So the network should be simple. It should be like a plug and play types. And both banks and the MSMEs should be able to switch between different LSPs on the platform in an interoperable manner, so that all the information, etc., that you had can be transported relatively seamlessly for forming new relationships. So for all this, one needs a digital infrastructure in between. Okay, so there is this sort of railway track that's in between, and that's supposed to be this open credit enablement network, which is a public digital infrastructure based on open standards to accelerate access to affordable formal credit. And that network sets a standard through which information is going to be shared, processed, and flows back and forth between the MSMEs, LSPs, and the lenders. Now, of course, LSPs may have their own specific ways of dealing with the MSMEs, but as far as the credit information is concerned, everything will get standardized through this open credit enablement network. So what is this? OCEN, as it is called, it's a common language. It's a platform, a digital platform, to communicate every step of the loan transaction between all lenders and all potential loan service providers. So just as the Bluetooth specification allows data sharing across Android, Apple, or other kinds of phones, OCEN allows many different kinds of lenders and loan service providers to communicate with each other through the loan process. Any MSME service provider can adopt OCEN to become a loan service provider and start showing their MSME customers the products that are being offered by any OCEN-enabled bank. So OCEN, as I stress this, it's a common standardized language for LSPs and lenders for loan application generation and submission. Then loan offer generation and communication about that, and ultimately for loan acceptance. And finally, all of this has to connect with other public digital platforms. So OCEN at the top is a part of it, but then you need other things as are listed here: Aadhar, account aggregators, UPI, autopay, and so on, RBI's public credit registry that's being set up, etc. And why is this other public digital infrastructure critical to make the loans fully digital and seamless for the MSME borrower? It's because you don't want physical documents or physical presence. And many speakers in the panel that I was able to witness just before were highlighting how just the 5-6 months of the COVID phase has led to tremendous digitization in their dealings with their customers relative to what was possible before. Now, some of this was already happening. COVID may have just forced the change or the switching costs, but clearly this is the direction to go. The key digital platforms seem to be Aadhar, e-sign, so you should be able to agree on contracts digitally, UPI for digital payments, account aggregator to be able to share your various pieces of information, bank accounts, mutual fund investments, other kinds of invoices, and so on, and a public credit registry. So let's go through this. Why do you need Aadhar? It's for the borrower KYC, or know your client standards being met. So, Aadhar eKYC can be used for the MSME borrower KYC for due diligence and customer identification and verification. For underwriting, banks will certainly need account aggregator and possibly public credit registry. The account aggregator allows data sharing across financial institutions. So past bank statements, future invoices, etc., that would be important in evaluating the risk of the loan. But you need the account aggregator. Of course, it will follow the electronic consent framework. So each MSME borrower can approve whether they want to enable access to information that's in the account aggregator or not. And then you might need the public credit registry to know what have been the past credit history transactions, a digital transaction register for each borrower. What are the current outstanding loans? Because it's just not enough to know the assets. You also need to know what are the other liabilities that the borrower has. Rest is straightforward. You need a loan agreement acceptance. So you need Aadhar e-sign for the borrower to verify their identity and accept and sign a loan agreement digitally using OTP. You need then loan disbursement and repayment. So for this, you need UPI and UPI autopay. So that would allow instant digital disbursement of loan and the borrower to consent to reliable recurring automated payments. And then finally, during the life of the loan, you may need some monitoring possibly. Account aggregator can allow the MSME borrower to consent to the lender accessing the MSME's financial statements for the loan period. So let me just walk you through one such transaction. And, it's sort of fairly interesting. So here's a loan transaction example. Let's say an MSME is selling products on the government's e-marketplace, GEM, to different government departments. Government departments pay after a few months, and the MSME would like a loan against a GEM invoice. Okay, so you're basically borrowing against your account receivables. The GEM can become the loan service provider here. So how does it work? So there is something called that is being piloted right now. It's called Sahai GEM, which is basically a loan service provider. So the GEM seller gives explicit consent on the GEM portal, the government e-marketplace portal, to avail order or invoice financing by Sahai GEM. So the MSME borrower says, yes, I want to be able to access invoice financing. The seller is then directed to install the Sahai app and link it to their GEM account. Okay, so this is it can all happen just through a simple app. They are asked to create their account. They enter the GST username and identity number. There's a two-factor verification with an OTP. Then their orders and invoices are now eligible to be shared as information collateral because they are already on the GEM platform because they are embedded in the ecosystem of the seller, the MSME. So there may be a bunch of GEM invoices and orders, and the seller can consent to sharing this information with the potential banks who are loan providers. And then a set of loan transactions become eligible, based on the sizes of these invoices. So you can see that the invoices will have the details, which ministry is actually involved in this, when the transactions are taking place, when are the payment dates, and so on. Now, all this information can go. I didn't share this, but account aggregator can here also provide information, can be linked in here on the OCEN platform. And so the seller can also share relevant bank accounts and balances and other information with the banks. They can again consent to it. And then the GEM loan service provider can make financing offers available to the MSME seller. Now, of course, at the back end, the banks now possibly need some digital program or AI to figure out, given the information collateral they have received, given their past track record of lending to MSMEs, what does that information collateral warrant in terms of a feasible, reasonable loan contract? And then, the loans offers can show up. So if you see here on the right side, you can see that ICICI, State Bank of India, HDFC, which are all OCEN-enabled banks, can present a series of loan offers, days of maturity, the interest payment that's going to have to be made, etc., etc. Then there's a facility agreement. So once the MSME has picked a specific contract, you can see the agreement. You can e-sign it, again, through a two-factor verification. And as I said, the key is that you should be able to do some cash flow entrapment, which is the banks should not have to rely through these sourcing and recollection agents to deal with the MSME. Whenever the MSME gets the payment through the GEM network, automatically a repayment can go straight into the bank account out of that payment. So this way, you embed the finance into the actual cash flow structure of the MSME, so that in some ways, using the information collateral before, this becomes more of a cash flow based loan rather than an asset based loan. And once you set up that automatic repayment, you get a virtual account being created. You can update your account details, etc., etc., and then boom, the loan gets disbursed at the end of the transaction. Now, I just want to make two or three final points. One, the regulatory, what would be the regulatory framework for these loan service providers? And the key here is that they are not third parties to the loan contract. And in their simplest form, they don't even advise the MSME on which loans to pick. All that they do is that through their facing of the MSME through an electronic network or an app, they basically channel information back and forth, and they allow the banks to link the repayment of the contract to the actual financial transaction between the LSP and the MSME. So the RBI's MSME committee report of June 2019 also recommended creation of such loan service providers, and it recommended that these be lightly regulated rather than be treated as financial institutions themselves, which would then be regulated as regulated entities under RBI. So to quote from there, it says that the regulatory approach of having a new lightly regulated intermediary like PhonePe, BharatPe, or Google Pay has been used with great success by the Reserve Bank of India in regulating the new UPI ecosystem, and thus can easily be replicated here in the context of loan service providers. Further, the committee recommends that the Reserve Bank of India facilitate the creation of a self-regulatory organization on the lines of AMFI and RIAs to organize and provide light touch regulation for this category of players. The report also highlights that loan service providers will offer individualized advice and should act in borrowers' best interests, respecting fiduciary duties of disclosure, loyalty, and prudence. Now, I still have to think through whether loan service providers should really provide advice on these financial products or not. I would be very comfortable to start with if they simply enable linking of the loans to the payments that they have being exchanged with the MSMEs. Nevertheless, there is one advantage of the OCEN, which is that the risks in the LSP to borrower interaction are somewhat reduced because everyone has to go through a standard network while sharing the information, for example. There is another possible risk here, which relates to the risk of sharing of information. Now, the borrower willingly consents to sharing the information electronically. Of course, having acquired the data, the lenders or the LSPs could potentially abuse the information. At some level, we have to wait for the details of the data protection bill on what the penalties would be for abusing information that has been consented for specific usage. Of course, there may be newer methods that are emerging. There's this concept of zero knowledge proofs that is gaining prominence in all these digital transactions. Maybe something like that will evolve over a period of time. But essentially, the self-regulatory organization slash perhaps even in conjunction with the Reserve Bank of India could come up with some guidelines for best practices. And maybe the collective of the loan service providers, there is one right now which is called Credol. It can actually design some safeguards so that this kind of abuse doesn't take place. Now, one reason why I think the abuse may not happen is because the LSP has an existing business relationship with the MSME. And I think this is key to everything in this model, which is that LSPs are not new selling agents which are coming out of the blue. They are already doing business transactions and value the sustenance of these business transactions. Okay, so let me conclude. It might seem that this all looks futuristic, but it's not a pipe dream, is what I'm given to understand. In 2020, especially perhaps because of the COVID shock, adoption has accelerated. And 4 points here. More than 30 MSME customer-facing entities have engaged to become loan service providers as of today. More than 10 major banks have adopted the bundle of digital infrastructure, UPI, account aggregator, OKEN. Many of these banks are in advanced stages in essentially becoming OKEN-enabled banks that could deal with LSPs to reach the MSMEs. Third, major government information providers, such as the GSTN or the government e-marketplace, are also coming on board as LSPs and sharing data on the GSTN and GEM invoices. And finally, new non-profits, Credol, Sahamati, etc., they have been built to encourage adoption of digital standards at banks. These non-profits, they connect banks with tech companies who help them adopt the OKEN for their loan provision. They also help them adopt account aggregator and UPI standards, because OKEN is basically this public digital standard so that everything is interoperable and portable. And this would facilitate different LSPs to partner with different banks, because it's really, once they are enabled on this platform, the OKEN platform, account aggregator platform, UPI standard, they can deal with any bank, and vice versa. A bank can deal with any LSP that is enabled actually to work on this platform. So the standardization is key to actually reduce the various costs that were being proposed as a hindrance for the credit to the MSMEs. So let me sum up. I think this is quite exciting, possibly. As I said, I have to think through more about whether they should really get into the business of providing advisory service or not. But it's promising because potentially it creates formal finance access to MSMEs. It can link MSMEs to the lowest cost lenders in terms of the cost of funds, which are the banks. And the vision is that this could open up 10 to 20 trillion, 10 to 20 lakh crores of increased liquidity into the system. And the key is that it is very heavily reliant on the digital infrastructure strides that have been made with India Stack and all of these various applications that have developed around it. In many ways, it is unique to India. The whole chain of APIs that have been developed now, from all the way from identity verification to payment, secure payment authorization. And if we do it right, if banks come on board, if banks at their own end, using the information collateral that they receive, design AI, machine learning, back-tested applications to figure out how much credit they should allocate. Of course, they might start out conservatively with a new borrower, give a small loan. As I keep calling it sachetization of credit in India. It makes perfect sense to start out with a small, short maturity loan for a new borrower, get them to build their credit register into the credit registry, and then gradually expand credit to the size that a particular borrower is deserving. And last point, the linking of the payments, repayments on the loan to the actual payments which are taking place can significantly reduce the incidence of fraud, non-performing assets, so that at least the loans which are safe but become risky because of poor recollection, poor recovery and collection infrastructure, can now remain safe loans. And if banks don't make further losses, the cost of borrowing for the MSMEs may come down across board. Let me stop there. You will see a few sites here. One is for Credol, which is this quote-unquote SRO for all these LSPs. There is a link here on the iSpirit open house that summarizes OCEN, where it stands and what are the next steps. And there are several blogs, as I mentioned, that have been written on this. There is also a video that I'll be very happy to share with you if anyone is interested, which kind of goes through this transaction onboarding through like an actual step-by-step process for you to see how this can be enabled. So let me stop there. I'm happy to take questions if there's time